Hello, YouTube. The S&P just put in 5 red days in a row, which is usually where we start to find relief. But this market is anything but certain. We are putting in new lows of the day, of the week, of the month, of the year. And the worst is yet to come. That is what the IMF told us today as they were having their big meeting. They cut the world GDP outlook, and the worst is yet to come. 1/3 of global economies may tip into a contraction next year, which means what? A global recession. Yeah, happy Tuesday. Here we are. It looks like it is a turnaround Tuesday where, to be honest, I'm actually really surprised we're opening and closing at about the same price. We opened at 35824. We're closing at 35774. What I would really pay attention to here is just that the worst is yet to come. The headlines are really bad. Systemic risk is high. We're going to go through and have a look at a couple of charts fast. And then we're going to go through, look at the headlines to explain what happened, and then look back at the charts to know whether or not what we were expecting to happen, whether or not it actually did or did not, because there is a lot of noise out there. I'm really trying to focus on the news versus the reaction to the news. So although I do still think we were repeating 2008, I'm going to wait until we actually get what I need to confirm we're getting there. I would say at least one more week closing below the 200 weekly. And what's really important for me is just that we're at a pivot. So as we're at the pivot, and we're currently in the chop shop, which I mentioned was 357 to 362. Well, that's pretty much the range on the day today. If we look back to the range on the day, we hit a high of 36303. Our low was 35571. That's almost perfectly within the chop shop. And no surprise, it was choppy action today. It was not nice at all. We got negative follow through after last week closing near the low. And we got our follow through. New low of the year, new low of the month, all that good jazz. Only chart holding up right now is ES. So as we are right now at the pivot, which is where we are, where we have roughly 15 points to get back up to our resistance or our bear market at negative 20, or about 15 points to go down to our negative 30 and our previous all-time high going back to February. That's really what it comes down to now. So we're looking for a push-pull off this area, and we're getting really close to support. So we'll see how close we need to get before we actually get some relief, because 5 back-to-back red days is quite a few. We don't often put them in. We do have 6 back-to-back red ones right here. We got 1, 2, 3, 4, 5, 6. And then going back to one of our last drops, we got 1, 2, 3, 4, 5. So technically, if we're going to repeat 2008, yeah, absolutely. We can put in more and more and more and more and more red days. We are due for relief, and I'm not sure if it's going to come tomorrow. As I mentioned on the weekend, I still think we're going to get an up move going into that CPI report that's ultimately going to get fatly faded. So I'm going to look at a few more things here because we're really comparing this move to this move, meaning the false breakouts we got over top of the channel. And now when we look at the percents from our low to our high, it's roughly 6% for the first wave. On the second wave here, roughly 6%. Cool. So if we repeated the roughly 6% on the, we're trying to carve out a bottom and then we push off. We're trying to carve out a bottom and then we push off. And now we're repeating the leg lower. Where do we start to find support? Where we get that green day, even if it's just one? Find some relief. Okay, well, let's just keep doing the math. It's not all that complicated. So from the high to the low, it's about 7%. That's correct, about 7%. So now, as we are approaching our area, what's 7%? Oh my goodness. It's almost perfectly on our 50 monthly moving average at roughly 353. Is history going to repeat itself? If it does, this is where the confirmation of a bear market of 2022 repeating 2008 looks a lot more similar than it would otherwise. I would also note, excuse me, if we are going to get that fresh leg lower, we need to see an increase in volume, taking out the previous high. Why? Because when I look at this, this looks like capitulation volume or a mountain. And where is it? Well, it's right around the low. And we actually closed higher than our low back here. Our low here, our close is 35718. Today we close at 35774. So it's sloppy, it's ugly, but it's actually not as bad as it was 2 weeks ago. Yeah, 2 weeks ago now. So we know that, okay, great. Worse is yet to come. We're making new lows of the year. Worse is yet to come. A third of the world's going to go into recession. Oh, yeah, that's like really good news. Then we look at, okay, if we're asking ourselves, well, they're pretty much telling us we have the recipe now to go to 2000 or 2008, which is going to be a negative 50 off the top. I'm not going to jump down that rabbit hole yet. I'm sure lots of other YouTubers are. That's not my point here. What I want to focus on is that we do not have what I need to confirm we are actually going down into here. I'll tell you what that is in a moment. If we're going to repeat 87, 90, 2011, 2016, or 2018, we cannot afford to bounce around here very much longer. We have to push off. We got to get off this 200 weekly. We got one low. We got one weekly close below. So that's one. Then we close above, and now we're back below. For me, I need 2 consecutive weekly closes below the 200 weekly for me to say that the change in trend is here. However, the problem is that we could be a lot lower. If we repeat 2008, we might only get that confirmation all the way down here as we're like a lot lower. QQQ already got it. It's got 1, 2, 3 weeks below. So it already had 2 closing out last week, even though it closed green. That's right. The Dow, I think it has 4. 1, 2, 3, 4. Russell, it's got 1, 2, 3, 4. Oh, man, that's like really bad. And if we think about the whole world going into recession, what's happening with the DAX right now? Because, oh, boy, is it getting stinky over there? Woof. We're still at 2020 levels. Where's the DAX right now? Man, it's all the way back to 2015 levels. That's right. A little bit of time below, a little bit of time above, right back to the median. Right back to where we were in 2017. That's like a long time ago. Whoa. So they're already down here. The only chart holding up is ES, as we reviewed yesterday, and the path of least resistance seems lower. So when we look at these numbers on the left for this year, which is projected, versus next year, which is an estimate, we look at, okay, well, US down 1%. EU from 3 to 0.5. Britain, 3.6 down to 0.3. China expanding a little bit to 4.4. But let's be real. We have inflation at 8%, right? We got a big 8%, even call it 5, whatever. And if we get growth of only 1%, what does that mean? Well, we're really losing 7. We're losing 7%. So the US is still the best game in town, but these numbers don't work. Math don't work. And for portfolio managers and people who move significant dollars, this doesn't really make sense. This is called stagflation. Stagnant growth or low growth or no growth with high inflation. That's what we're hearing today. This is like the worst case scenario. Let's read a few more headlines to see what's happening. IMF Global Financial Stability Report says financial stability risks have risen since April report. Balance of risk significantly skewed to the downside. Nice. Rapid rise in rates could fuel global economic disorder. IMF warns. Deteriorating market liquidity may pose risks to financial stability. Risks to financial stability. That's where if the Fed's trying to land their plane, well, man, they might blow up the whole world as they're trying to do it, right? That's not good. IMF is the International Monetary Fund. That's the World Bank, basically. Central banks should continue to normalize rates to tackle inflation. So a little bit of comedy. Let's move forward to some comedy. Put your mask on first because we're going in for a hard landing, a crash landing. Make sure you got your mask on first because that's all we can do in this environment. Take care of yourself. So as we read the next articles here, this will make sense. BOE's Bailey. Pension funds have the resources they need. Bringing them over is the challenge. BOE's Bailey says serious risks to financial stability in the UK. BOE's Bailey says market volatility went beyond bank stress tests. He is pulling out support. On Friday, they're going to stop buying stuff. Where's the FTSE here? There we go. FTSE 100. Yeah, nice little chart here. Yeah, all the way back to where we were in 2018 too. Yeah. So as we look here, all this tells me is that they're removing the liquidity. So if we think the Fed's going to be the backdrop right now, the S&P is currently still only pricing in a garden market variety recession. Why? Negative 20% is the average when we go down. Where is that? It's at about 350. So if we get down to 350 or we go lower or complete the 2018 pattern, which we'll talk about in a later video, make sure to subscribe. We're going to probably follow. So we're still assuming Jerome's going to pivot or pause or do something or nothing's going to break. And right now shit is breaking. And remember that UK is a G7 country. So when they have margin calls, what are they probably selling? Well, the same thing they sold last week when the first headline started going through. They're selling the most liquid security in the world or whatever they got in their portfolio that's green. What is that? It's SPY. So SPY is getting sold off because there is systemic risk. It's a big deal. Also note here, New York Fed September household spending drops biggest in series. Yeah, why is that important? Well, we know that 70% of the US GDP is what? It's the consumer. So the consumer is currently spending the least amount it has in the history of its reporting. and we're supposed to not be repeating a deep global recession. Oh my goodness. September home prices rise. Rise expectations at weakest level since 2020. What does that mean? Prices are stopping to go up. If they start going down, that's going to cause a negative wealth effect, which means people are going to feel poor. New York Fed, September year ahead expectations, inflation's at 5.4 versus 5.7. Oh, right. There's the stick save. We got it, boys. We got it. And I say that because when we get our inflation print on on Thursday, we're expecting a little tick down. I think the market's still going to rejoice, cheer it on, and maybe we get the final little kick going into the end of the month. However, the middle of the month, right here, where we have our normal second year for a Democratic president. The problem is that Governor Bailey might have just messed this all up, where we don't get all the relief. Might just be fizzled out on Thursday. Why? Well, the UK closes before we open on Friday. They close as we are just starting to trade on Friday. They're ahead of us. So these meeting minutes are going to be really important. Christine Lagarde speaking is going to be really important, but the CPI is going to also really matter. I think in a normal year or even in October, we normally go down. We're still looking for the move up here, right? Looking for that tick higher. Is it going to happen? Maybe. And what all this means to me, what I'm thinking about, all right, we have a really big roadmap ahead of us. So we're going to keep going lower. And an easy way to think about this is whether or not people are exhibiting the warning signs of anxiety. Why am I getting margin calls? The rip is taking longer than expected. I bought the dip and oh baby, it's not working out. That's kind of what all these headlines tell us. So if we don't hear a pause or a pivot from the central bankers, we're probably heading lower. And with all that said, now we're just going to look at two quick charts to see whether or not we actually understand what's going on here. And I can tell you there is a ton of option motivation going into the end of the week, but we're not going to look at all that because frankly, we can find whatever we want in there. So when I look here too, yesterday we looked at oil. Oil really told me whether or not we were believing what we heard from Russia. We're down another 2% on the day, 2.8%. We're down 4.4 in the week. It's a nice little rejection here off the 50 weekly instead of a bullish pattern, which we reviewed yesterday. So that kind of tells me, hey, maybe Russia's ready to maybe pull out, right? Maybe they're ready to actually stop this nonsense, right? Hopefully, fingers crossed. Now we're going to look at the dollar. So even with all of this, excuse me, all of these headlines, what happens? Well, the dollar is up by basically 0.1 on the day, which means this is like the Lehman Brothers for the whole world moment. Everyone should be flocking, being in love with the dollar. Not so much. We're basically flat. Does this mean we're at peak dollar? Are we at peak hawkishness for the Fed? I'm getting a signal. Again, there's zero confirmation. It's just a signal. And then for gold, well, gold actually doesn't look all that bad today, right? Only down by $1, $1.60 or 0.1%. Why? Gold is boring, predictable, but stores its value. That's why. When we look at the Qs, though, oh boy. Let's look at our daily chart here for the Qs. Q. And we note that, this is where? Well, this is our first daily close below our 50 monthly. That is not good at all. So with all that said, if you want to watch more, I encourage you to watch the video now. Otherwise, thank you so much for tuning in. And I very much look forward to seeing you tomorrow. Thanks so much for tuning in.